Hey traders, this is Blake Morrow with Traders Summit, and I have a very special guest today. I have Mr. Tavi Costa, portfolio manager at Crescat Capital. Good to see you, Tavi. How are you today?
I'm very good. Thanks for having me.
I'm really excited to have you here at the at very end of the year, end of a very exciting week of central banks meeting this last week, and last night we had the Bank of Japan. A lot of excitement, a lot of volatility in the markets as we're wrapping up 2002, and I think it's a perfect time to talk to you as traders and investors are really starting to worry about the risks of a severe recession and what it looks like moving forward. So I wanted to get your opinion and get your views on how you feel about going into next year. How's your temperature right now on the economy?
Well, I have mixed feelings about a lot of things and very strong views about other things. So, from a trader's perspective, we've had a 9% downward move in a couple of days for the S&P 500, which makes it more and more difficult to have a short exposure in the short term. However, the medium term looks to me continuing to see confirmation and validation of the bearish thesis, and for a lot of ways. I mean, to me, the biggest thing that happened in terms of macro indicators was the percentage of yield curve inversions. I think a lot of people have looked at different forms of yield spreads, but the yield curve inversion percentage is the most important one. I created this back in 2018. And what I found at that time was that every time we go above 70% of the entire treasury curve being inverted of all possible spreads, you are really at the beginning of a steep recession that is followed by also a downturn for risky assets. Majority of them would be, in my view, equities, but also corporate bonds and other things. And so, to me, that's really the biggest signal that we had. And back in other times, certainly majority of those periods that we went above that 70% were also in line with when the Fed had to move away from their tightening policies or start to even cut interest rates. And today is a different environment in that sense, because inflation is still in the system. And yes, it's been decelerating, but, way above the Fed's target. And even with the Federal Reserve raising rates, when you look at rates relative to inflation today, the negative, real rates is one of the most negative levels that we've seen in history. And so when you think about that, I still, I don't know how steep of the recession is going to be. I think it will depend on the Fed side of it, but I feel very strongly that my research in yield curve inversions will probably be right one more time. And that's for positioning purposes. I am very still short the markets. I'm short mostly, especially corporate bonds and mega cap stocks that have just started to underperform most of the overall markets and equal weighted indices and so forth. I think that's a pocket of the market that seems extremely overvalued still. The Apples of the world, the Teslas, Microsofts and Googles and so forth. I think those look very attractive, and I continue to be short. And I think there is sort of a debate in the community of macro community, which is related to this idea of, are things mostly priced in stocks in general? Most people are expecting a downturn in the economy. Are things really priced in already, and there's not much of opportunity in the short side? I disagree. I think we're entering a phase of where bad news are going to become really bad news. As far as market goes, I think we're entering that phase. It's one thing when you raise rates from 0 to 4%. When you go above that 4 to 6% kind of range, that's when you start seeing frauds being revealed and start seeing real problems unfolding. And I think we're at the beginning of that now, and where you can really see a credit collapse or some sort of, real credit event, which we haven't seen it yet in a big way outside of the crypto market. So I'm watching for that as sort of the next step here, and I am very bearish in general because I think QT is the most important part of liquidity in terms of markets as a whole. I mean, QT, as far as what they've been allowing their balance sheet to be depleted, is a huge part of this whole thesis, because it is on a rate of change basis actually getting worse, not better, not like interest rates that are, the incremental amount of rate increases is actually declining now. We went from 75 basis points to now 50 basis points. They might even signal 25 basis points soon, and then nothing.
Yeah.
And so, but the QT side of it is still increasing over time. So to me is a bigger deal.
So, from what it sounds like to me, things are going to get worse before they get better. But when you're talking about the Fed and you have a Fed chair that seems hell bent on making sure that he brings inflation down to his 2% target, which, it's debatable whether he will be successful or not, I think, by most analysts right now. But what do you think? Do you think that the Fed is even possible, could even fathom thinking about stopping QT, lowering rates in the event of a severe recession while inflation is still well above 2%? What are your thoughts there?
Well, so the question, while seems relevant, and I think it is relevant, I think for positioning purposes, there's maybe a better way to maybe tackle this issue. And I'll propose a different way to answer this. But
right.
First of all, I think that if you look at what's been causing inflation, which has to do with wages and salaries growth, the scarcity of commodities and supply shortages in general of that space, then the reckless amount of fiscal spending, and the fourth one is deglobalization trends that are intensifying over time. All four of those pillars have not been resolved, and they're all secular changes, and they're all been, still working in the system. All we've seen is that prices went up too much, and now we're seeing a normal deceleration of inflation, where I think a lot of people are seeing this, the first wave of inflation. Usually inflation works through waves, and this very first wave of inflation has maybe already been completed. And so a lot of people will mistakenly think that inflation is over, when I think the second wave would be even more important, and the third one later. And so, to your point, if we do have that type of shift in terms of policy, where liquidity is actually added to the system, this will be relevant for equity markets. I have no doubt about that. Now, it will also be incredibly relevant to commodities and tangible assets that are likely to go higher, way higher than equity markets in general. So for positioning purposes, while I keep repeating this, to me, and I will keep repeating it because it's the best opportunity out there, is to buy commodities and sell stocks. I mean, and that basket of commodities will shift over time depending where we are. So you're now in a cyclical downturn, while, you should really be favoring in your commodity basket, calling gold a commodity, but, people have different views on that. That should be your favorite one right now, because, at a time when there is pricing risk of a pivotal moment from the Fed being priced in markets right now, those things will actually likely be favorable for precious metals, especially right now at a time when precious metals have actually lagged most commodities. So hopefully I'm answering your question, but
Yeah.
It really is the commodities to equity ratio that will likely continue to go higher regardless. It could be a steep recession that causes equity markets to fall further, or is a pivotal moment from the Federal Reserve that may help equity markets, but really help and unleash, another big move in commodities that could be driven by have different leadership than we've seen in the last 20 months or so, which has been mostly from cyclical things and agricultural and other things. And now they've taken a break recently I think it's really a break. I don't think that the real structural problems in those that's been causing inflation to rise have not been resolved. In fact, I think the tightening of monetary conditions, if anything, only is helping this case for commodities over the long term. And so I don't know. I that's the way I'm seeing things. And when we've done research in the yield curve inversions, what we found is that the best trade is not even commodities to equity ratio, is gold to S&P 500 ratio over the next 2 years after you get the 70% yield curve inversion, which I think, when you have markets already down 30% in the equity side and gold is basically just starting to move, I think the gold side of it is looking more and more and more appealing.
That's it. That's interesting, and I guess and I didn't even bother to ask you this ahead of our interview, but then if you add China and a China reopening, I mean that could be another inflationary environment coupled with what you're discussing as well, right?
Well, there's that, but there's also the have you seen just if you look at DXY index, for instance, it certainly has been declining relative to other currencies, and the impact of that on import prices. We've had an inflationary period on the back of a very strong dollar, but now we're seeing a weak dollar. And so what's that going to impact import prices, which is a huge part or a huge variable for the inflation question. And so when you ask the question of how steep would be a recession, I think there's two things that I'm watching very closely. One of them is, have we really completed the first wave of inflation? It likely we did, but how much of a deceleration are we going to see? It will bottom at 4%, 2% negative. In my opinion, it will be higher than people believe. And if that's the case, the recession will be steeper. That's my base case. I think that that's what's going to happen. I think inflation, given the fact that structural problems have not been resolved, it's hard to believe that inflation will really fall as much as people are currently planning. If you look at most economists right now in terms of their prediction for where inflation is going to fall, a majority of them do believe we're going to see a steep decline in CPI growth that will likely go back to where the Fed's mandates have been, which is 2% or so. It's not my view. I don't think we're going to go there. I think it will surprise me if we go there, because I do think if we see, first of all, any sort of real growth problems in terms of the economy and economic activity beginning to really fall apart, which I think I think the first, the next 3 months are going to be very brutal for fundamental data. I mean, I can't believe that we're not going to see the consumer getting completely squeezed, especially now in holidays data. And at the same time, that's not going to be impacted in equity prices over time with, earnings are still really high in terms of estimates. Margins are still very steep and are likely to contract. And so all of that is still in front of us. And that's going to be the bigger part of the story for the next 3 to 6 months. And how the Fed reacts towards that is going to be the big story for, for the commodity side of the trade after that, which, if they reacted in a large way by cutting interest rates and doing all sorts of, things to promote growth, I don't think oil will be trading at $70 a barrel. It will be trading way higher than that. And then the cyclical side of commodities may really go crazy. But first and foremost, I don't think gold will be trading sub $2,000 an ounce either. And silver probably will be a lot higher. And so there's a lot of, I think, fund allocations in terms of changes of portfolio construction that will be changing. And the BOJ story today, by the way, that happened today is very relevant for this whole story. Very, very relevant. Because
in what sense?
I posted a chart. Well, I posted a chart the other day, and I think it's a narrative that is kind of emerging that I'm really trying to emphasize here, because yes, we've had this kind of gold bug mentality and thesis over the last years that has been proven wrong, in my opinion. And the real thesis for gold is the fact that we're seeing this pressure from most investors towards central banks to improve the quality of their international reserves. I mean, countries work just like companies. They have to have a certain degree of quality in their international reserves in order to support their monetary system. You know, what is a currency worth? A currency is worth whatever they have in terms of quality of their international reserves. Back in the days, used to be the biggest, the best quality asset one could own is gold. And now we shift away from that towards other things like U.S. Treasuries and other developed economies debt instruments, literally. And so if you look at the composition of central banks' international reserves, gold used to make up of close to 74% of those reserves. And now it's close to below 18%. So, and we've been seeing record amounts of central banks buying gold recently, especially, or on a 5-year window, whatever you look at. And so it is of my view that the percentage of gold holdings relative to international reserves is likely to go much higher as we see the pressure from investors towards the devaluation of fiat currencies, which we've been seeing in many ways through waves. Some of them started with, you know, emerging markets, and then now we're seeing developed economies have issues. Look at the yen, right? Look at the British pound in the last 6 to 12 months. And then, you know, the dollar is now suffering the pressure. It's been kind of moving to one to the next, and that pressure will cause central banks to own gold, in my opinion. And on top of it, you have the deglobalized side of it, which is a huge part of this, where, you know, countries are looking for a neutral asset to own. I mean, how good is to own U.S. Treasuries when if you break the relationship with the U.S., you can't use them as part of your reserves to protect your currency over time, like Japan is doing, selling U.S. Treasuries right now in order to prop up their currency at this moment, happening right now. Now, how do you think the yen is rallying today? I mean, it's not because investors are happy with the decision that the BOJ is allowing interest rates to rise, because on an interest rate differential, it's not even that attractive right now. But what's happening is that they're selling treasuries to support their currency over time. That is my view, and I think factually we'll see this in a few months with the decline of their foreign reserves, which has been happening. So, bottom line is, the situation that's happening is just showing, you know, think about the 60-40 portfolios completely failing recently. You know, what are they going to do? They need to improve something. They need to change their portfolio construction. And it is unlikely that they will double down on sovereign debt exposure. It's my view that they're going to go look for other alternatives. And then you have the crypto market completely collapse. Is that the alternative? Probably not. What is it, the alternative then? Then it's probably gold. And I think people are starting to sniff that around. And the only reason you can see that is the breaking correlations that we're seeing over time. I mean, look at global bonds relative to gold. Global bonds collapsing and gold holding up. They've had a very strong, remarkable relationship over the last years. TIPS, Treasury inflation protected securities, which are supposed to work during inflationary periods, collapse, and gold has been holding up. Yen, Japanese yen, another safe haven, completely collapsed. So most of the haven assets have been in a declining trend, not working as haven assets are supposed to, giving a questioning to a lot of portfolio managers, including central bankers, of what should be the allocation right now. And I think gold will play a role here, a very big role, at a time when everyone is bearish on it, including gold miners that are not producing gold anymore, not investing in gold projects. You know why? Because of ESG policies. They're being forced to invest in copper and critical metals and other things that will help that's how they are raising capital from institutional guys. Because if they focus on gold, nobody wants it. And guess what? We've had 2 gold markets since the 70s, and both of them were marked by a declining production of gold. And we just started that in 2020. So sorry to go long here, but that's what's in my mind.
That it's always great having these conversations with you, Tavi, and that's why we invite you over to the Trader Summit when we do our semi-annual events. Invigorating thought process, and it really makes us as traders think about our macro bias as we're approaching the markets. And I think you just sold a bunch of traders on being long gold. So I do appreciate your thoughts, and really I appreciate your thoughts for our community ahead of the holidays this season. What's the best way, if for some reason traders haven't heard of you before, what's the best way for them to follow your work?
They can see my work on Twitter at Tavi Costa is my handle. They can also find our website where we put out in-depth research, including letters. At Crescat.net is our website, and you can just go there and click on investor letters, and where you can find most of our research there. We just put out a good letter called the Mining Industry Renaissance, and I think it's a good template for understanding the gold thesis in general right now, and explaining this sentiment shift and the macro drivers for the trade in general long term. So hopefully that will be useful for other folks.
It sure will be. And I'm sure you picked up a lot of friends and a lot of followers today with the Traders Summit community. So thank you so much. Happy holidays to you. And we'll look forward to catching up with you in the turn of the new year.
Thanks, Blake, and to you as well.
Thanks, Tavi. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.